In this video, I'll be showing you why still working past 63 with over $1 million saved means you're no longer working for security, you're working for the IRS. Through working with clients who kept grinding into their mid-60s despite having more than enough, I've discovered that fear keeps people at their desks long after the math says they could leave, and every extra year costs them more than they realize. And that's exactly why I'm making this video today, to show you why your problem at this stage isn't your balance, but your timing, and why working longer is quietly costing you tens of thousands in future taxes while it's draining your healthiest years of your life. If you're new to this channel, my name is Cody Gunn. I'm a CFA charter holder and the founder of Arrowstone Wealth, where we help our clients retire early through smarter investing and lowering their lifetime taxes. And with that, let's dive in. Let's start with the uncomfortable truth. What happens to your taxes when you keep earning a full salary past 63 when you have $1 million saved? When you were 45, every dollar you earned felt like a victory. That money went into the 401k, it kept compounding, and it was helping you build that $1 million safety net. But you were in the wealth building stage, and now you've crossed the financial horizon. Think of it this way. Your tax liability in retirement is a stack of financial building blocks. When you keep your full salary coming in at 63, you're building an unnecessarily high stack. That salary piles on top of future Social Security income. It piles on top of your investment income, interest and dividends. And it guarantees a bigger future problem when required minimum distributions, or RMDs, kick in. This stacking does two things. First, it pushes you into higher tax brackets now because you're still getting that high paycheck. You're losing valuable income to higher marginal tax rates. You're not just paying federal income tax, but often state taxes, and the combination means a substantial chunk of every dollar that you earn is going directly to the government. Second, it's building a bigger base for higher RMDs later, guaranteeing that you'll be in high tax brackets then too. The end result? The paycheck that felt like security now is just feeding the tax machine. Most people in this situation don't realize they've crossed the line from building wealth to funding the government's next infrastructure project. And why does this specific age, 63 with $1 million, change the math so dramatically? Well, frankly, at this level, if your portfolio is structured correctly, you likely already have enough to retire. The return on investment for working another year is now suffering from severe diminishing returns. Imagine you need $100,000 per year to live comfortably in retirement. If you earn $150,000 now, the first $100,000 is for your lifestyle. The remaining $50,000 is just extra, and most of that excess goes towards the higher marginal tax bracket and is then funneled into tax-deferred accounts, only to be taxed again later when you take it out. You're putting in 2,000 hours of your life, but after taxes, and we'll get to the other costs in a minute, you're netting a smaller and smaller percentage of that income. The break even on working another year gets worse the more you already have. So if the math doesn't support working longer, why do people keep doing it? Honestly, it comes down to one thing. It's the fear of spending the money that they've spent 40 years saving. We spend our entire lives internalizing the message, save, save, save. But we're rewarded for the delayed gratification. We've built a powerful savings muscle. Now the object has changed to responsible spending and distribution. It's the fear of retiring too early. Even though 63 isn't early by any reasonable measure, the culture still romanticizes working until 65 or even 67. There's a psychological safety blanket that comes with a higher status, a salaried job. Now, I understand these fears. They made sense when your balance was, say, $300,000 and you were still accumulating wealth. They don't make sense anymore when sophisticated modeling confirms your financial sustainability even through severe market downturns. Fear-based decisions are the opposite of data-driven decisions. They ignore the actual numbers that are right in front of you. When you let fear drive, you trade real, measurable years of health and freedom, the years you're most capable of actually enjoying your wealth, for imaginary security that you already have. The cruel irony is, fear of running out of money often leads to running out of time instead. You delay retirement until 67, only to find the things you wanted to do, maybe the big hiking trip or the multi-month trip to Europe, are now physically more difficult. Or perhaps your spouse no longer has the same energy level as you do. They don't want to go. You have to stop letting fear keep you from learning how to actually use the money that you spent a lifetime building. The goal of retirement is not to die with the largest possible portfolio. The goal is to die with the right amount of money after having lived a rich life. So fear is driving this actual decision, but let me show you what fear is actually costing you in real dollar terms. The cost of working longer shows up in two places: your lost opportunities and your future liabilities. Let's talk about lost opportunities first. What tax planning opportunities disappear while you're still earning a salary? The single biggest one is the Roth conversion window. When you finally retire, your income drops dramatically. This creates a low income window, a few golden years between your last paycheck and when Social Securities and RMDs begin. You convert small chunks of your pre-tax IRA or 401k into tax-free Roth money. You pay the tax at a low rate, maybe 10-12%, to save massive taxes later on. Every year you keep earning a full salary, you're pushing those conversions into higher tax brackets, maybe making them impossible altogether. The window between leaving work and RMDs beginning at, say, 73 is pretty finite, and you are burning that window at your desk. People who work until 66 or maybe even 67 often have very little conversion window left at all, if any. It's an issue of timing the income gap. By working, you are actively choosing to close the only gap that you have. Next, what happens to your future RMD situation while you delay? While you work, your 401k and IRA keep growing. Great, the balance keeps growing. Terrible for your future tax bill. You're not drawing down those accounts and they are compounding into a massive future distribution problem. The responsible choice of working longer is actually building the exact tax bomb it was supposed to prevent. Every year you delay retirement makes the RMD problem you face at 73 significantly worse because you've allowed the principal to grow unchecked within that tax-deferred structure. Now that you see what working longer costs you, if you want help figuring out whether you should actually still be at your desk, click the link below to book a call, where I'll run the numbers and show you what leaving now versus later actually looks like. Now, this one catches almost everyone off guard. How does working past 63 affect your future Medicare costs? It's called the IRMA surcharge, which stands for Income-Related Monthly Adjustment Amount. Medicare Part B and Part D premiums are not flat. They're based on your modified adjusted gross income from 2 years prior. This is a crucial part. If you work a full salary in 2024, that high income will trigger a surcharge on your Medicare premiums in 2026. Why does this matter to you? Because the income thresholds for IRMA are surprisingly low for high net worth individuals. Your full-time salary almost certainly pushes you into those higher tiers, and this is not some small fee. These surcharges can add anywhere from $2,000 to $8,000 per year per person, depending on your income level. So if you're married, those surcharges double. People don't connect their current salary to future Medicare bills until they see the statement 2 years later. The 2-year look back makes it feel completely disconnected from your current decision-making. You stop working in January of 25, but your 24 income is still hitting you with IRMA penalties in 2026. You thought you were retired, but you're still paying the cost of that old job. And let's be honest, Medicare premium planning isn't something that most employers or HR departments explain when you want to walk out the door. It's too specialized. By the time you see the bill in 2026, it's too late to do anything about the high income you earned 2 years ago. Working one extra year can trigger premium increases that last for multiple years in your retirement. That one paycheck you didn't need just cost you thousands of dollars in more premiums down the line. So we've got the tax hit, the lost conversion window, the Medicare premiums, but there's one more cost that doesn't show up on any statement, and it's probably the most important one. So what are you trading when you keep working past 63? You are trading your healthiest retirement years. I call this cost of capacity. When you retire at 63, you have a higher capacity for travel and physical hobbies. Your energy is robust. That energy and physical capacity decline with each passing year in ways money just simply can't reverse. The experiences you save for are happening while you're still sitting at your desk. Working until 66 or 67 means fewer years with full physical capacity to enjoy what you've built. You've traded time for money for 40 years. Now you're trading the most valuable time, your years of health, for money that you don't even need. So why doesn't this cost show up in retirement calculations? Because spreadsheets don't have a column for years of good health remaining. The financial planning industry for too long has focused exclusively on optimizing portfolio size when it should be optimizing for years of freedom. The real return on retiring at 63 versus 66 is not just dollars. It's experiences, memories, and the feeling of being the primary steward of your own time. Now that you see what working longer costs you, if you want help figuring out whether you should actually still be at your desk, click the link below and book a call. And I'll run the numbers to show you what leaving now versus later actually looks like for your specific situation. So what does retirement at 63 with over $1 million actually look like? Well, for starters, it looks like control. When you leave the office with a plan, you immediately open that low income window for Roth conversions at tax rates that you're probably never going to see again. You start controlling your tax brackets instead of having your salary control it for you. This is the difference between being a spectator in your financial life and being the conductor of your finances. You shift from reactive tax management to proactive tax engineering. You begin drawing down accounts strategically before RMDs force withdrawals at possibly higher tax rates. This is all about smoothing that tax curve over the next 20 to 30 years, rather than letting the government dictate your tax rate in your 70s. The money you spent your life saving finally starts working for you instead of the IRS. You get years back that you would have spent at your desk for diminishing returns. Your health and energy go towards experiences, grandkids, hobbies, travel, instead of commutes and meetings. You get to finally engage with the world on your own schedule. Your retirement becomes intentional, not just something that happens to you when you're tired of work. Now that you've seen why working past 63 with over $1 million means you're working for the IRS instead of yourself, and how every extra year costs you in lost conversion opportunities, builds bigger RMD problems, triggers unnecessary Medicare surcharges, and trades your healthiest years for a paycheck that you don't need, you can finally make this decision based on math instead of fear. Your wealth has done its job. It's time to make sure your planning does its job. If you want help building your dream retirement, click the link below to book a call, where I'll show you exactly what leaving now versus later looks like for your specific situation. Thank you guys so much for watching this video, and I'll see you in the next one. Cheers.